All right, hello guys, and glad to have you on board again today. Happy New Year for those who are looking at this one for the first of the year. Those of you who don't necessarily look at the longer term kind of reviews and stuff like that. So this is basically, this series of video will be specifically targeted for these types of users, those who want to trade anything that is intraday, and that's also the reason why I decided to rename those podcasts in 2024 to be called intraday briefings, because that's what I think they should have been named all the time. Then basically we're going to set a clear frontier now, which means in these specific videos we're not going to take care of anything that's above daily. That means this is for the weekly references and all these things, okay? So remember, when you're doing anything below this time frame, you've got two options. Either you're going to be able to trade ranges, okay, on multiple time frames, and this is what we're going to introduce as well. And we also have the ability to trade flows. Remember, flow sequences generally trade 3 time frames below the low risk strategy. If you take into account the flow strategy, that's what we've introduced basically last year, and to say if you've identified a low risk area, or if you're just listening to the weekly briefings just to take out those low risk areas out of this, well, this is purely simple. Whenever the prices reach out to those low volatility, to the low risk area, you know that 3 time frames below, the general market response out of these areas will have a likelihood to follow some sort of sequence. That this sequence is described by what we've highlighted in the general sequence of the flow. Okay, so that's basically what this is all about. In order to navigate this thing pretty straightforwardly, you don't really need that much complexity. It's just there's a pattern that repeats itself over time that's pretty easy to navigate, and it uses moving averages and Bollinger Bands to target the entry points. The difference with this strategy is that it doesn't really take or account for any risk management. It's just basically, well, buy at the moving average, buy at the Bollinger Band, and don't get too much complex. Whenever you break the channel, take your profits on the third range boundary type trade. That's really the way to go. It's really, really easy to navigate. The truth is, the complexity for this pattern is only relied to the low risk strategy assessment. That means you still need to learn the goddamn strategy to figure it out on your own, or you're going to have to listen to the weekly briefings, and therefore I'm going to be doing it for you. So that's really the way to go, okay? So what we're going to be doing in here is, of course, in 2024, we're going to keep doing the follow-up trades of the flow sequences for the assets that we cover in the weekly briefings. That means the S&P 500, the top cryptos, and eventually some commodities as well, okay? Though for the commodities, we're not going to do it anymore because, as you've seen, silver and WTI kind of as well are trading on larger time frames, meaning even the flow sequences on those assets are on daily and weekly, which is for now above the frontier, okay? So we're not going to do this anymore for those commodities, okay? So remember what there is. If the low risk strategy is daily, weekly, or monthly, then we have an opportunity to get to trade 4-hour, H1, or eventually even 15 minutes, okay? And that's really the way to go. That means we have exploitable flow sequences if and only if the major trend has reached a low risk area on daily, weekly, and monthly. All right? That's purely simply that. The second thing is that, as we know, we can always add up prices to this. That means out of the flow sequence, there's also volatility. We've briefly assessed that last year, and we're going to just do a quick recap of it. That means once you've highlighted the time frame in which your flow sequence is actually happening, okay, then, for example, the S&P 500 is in the H1 time frame. All right, give it a second to plot. Okay. Well, that means you can exploit the 2.5 standard deviation. Remember, this is 2.5 standard deviation. It's really important to figure that one out. And anytime you will get a volatility expansion, that means both the Bollinger Bands go in the opposite direction, okay? Then they need to converge again, 2 of them going right back into a same standard point. So spreading, converging, and then you'll be able to blindly trade at the Bollinger Band 2.5 standard deviation. Okay, you can do it several times in a row, but don't do it too much. Okay, and just do it like that. The longer you play that game, the more dangerous it will go. Okay, always the same strategy for this. When you reach out the moving average, you can do a partial profit taking and you can lower your stop losses, and that's really the way to go. You take your profits on the opposite boundary and you repeat the operation on the other side. That's really the way to go. Okay, so when you sell, you partial profit take eventually, or you put your stop out of the previous market top when you reach out the moving average, okay? And when you reach out the opposite band, take your profits entirely and reverse the trade. It's just the way you go. You stupidly trade the market moves, okay? And of course, follow the sequence as it goes, okay? So quick recap in here for those who want to know more about that. But you've got a full track record of 1 year regarding this. And that's basically the way to go, okay? If you do this, then that's how you go. Last year, we've highlighted the fact that we've gone through a weekly low risk strategy area, as by default, that was the only thing available for us, forecasting that the monthly chart is excessive or has been excessive in the past. It's starting to normalize, okay, sure thing, but back then we had no clue of that. Remember when we were back in October 2022, it was just excessive. So when the market is excessive, you go look for anything you have elsewhere. That means on the monthly chart, we surely might see a trend in here, but it really doesn't necessarily sequence like a trend. So truth is, we've gone to 1 time frames below where this wasn't excessive back then. We did have nice context, and what we've highlighted back then is following kind of a weird goddammit range, okay? We have highlighted a sequence which we know, which is a trending sequence that goes by breaking the lows of the range, okay? You have your range, you're breaking the lows, and then you're breaking out of it to the upside, of course, and you're trending, meaning your moving average gets out of the context again. And it does it after a V-shaped reverse. We know that by definition in this type of market context, there's only one trending context that fits the plan, and that's the wave 5 extended, the wave 1 extended. That means this structure will absolutely wreck everyone who's trying to short sell in here, and it's basically going to extend out of this, out of 2 pullback sequence. That means there will be a first pullback, which is exactly what we have in here. Okay, as you can see, short term has been making mature boundaries. Then we go all-time high again. We do a second pullback, which is going to do the same thing, terminate a bear cycle, build a mature range on the lower time frame, and so on. And we're going to get a second final excess to terminate the overall structure. Okay, and that's it. And then we're going to range again. That means after this trend, we're going to range again. Okay, it's really, really important to figure that one out. So until monthly gives us something else, which means so long as monthly doesn't change the context, the best we can navigate with now is the weekly. And the weekly told us wave 1 extended is at play. Therefore, we have traded the flow sequence in H1 time frame. Okay, so I'm just going to scroll it up to 1 time frame above to just have the vision to the whole sequence. And that's exactly what we've done. We've had the first flow in here. There we've fallen to the to the moving average in here. So the third range boundary happened there, if my memory is correct. That means this is where you would have traded the moving average. Second flow sequence traded in here. I don't remember exactly, but I think the third range boundary was right there. Then you get your corrective trade. You've got the Bollinger Band trade here. It was a bit higher, I guess, and I remember this area was kind of hard to navigate. Was psychologically complex, but still worked out, and you had the third and final flow there with its third range boundary, I guess, somewhere like there. So that's really the way to go, okay? 3 sets of flows. The strategy tells us give it some room to breathe, give it 2 consecutive bearish flows, and then you start all over again. You got the first flow there, you've got the third range boundary somewhere like that, you had the Bollinger Band trade here for the second flow, which we traded, you got the third range boundary taking profit out there. The market gave it another breath, but that's really the way to go. We have said afterwards, same story, we need to find a third flow, so we waited for the Bollinger Band. My memory remembers it was somewhere like there, okay, and it was once again a tricky area to navigate, just like this one. Some people got stopped. I barely got stopped myself. Remember, the maximum stop loss must have been below this area, and this is where my stop losses were. So as you can see, very, very close game in here. Third flow triggered itself, and we're now in it. Okay, and as you can see, we made new highs. So everyone has its stop at break even, and now we have the third range boundary going as we speak. Okay. Truth is, I'm going to show it to you. Okay, so 1 hour time frames, you can see very, very brutal move to the upside. Whoever shorted it, it's just been pain traded. And now we've reversed the context, and third range boundary is playing as we speak. So now is the appropriate time for you to take your profits. Okay, Remember here, you don't trade the third range boundary when you are in a squeeze of the high time frame. So here we definitely got out of the squeeze, so there is a third range boundary. All right? So out of this, well, multiple things can happen. Just like before, we can see a third range boundary that's going to be fucked and retraced, and then the market goes back again. That's really the way to go. Though out of here, we can make new highs, retrace to kind of catch up with the bulls and go for the future and go for some higher trades, and then the market will reverse later. Okay, so that's really one way to do it. Or this third range boundary will terminate the sequence, and that's it. And we're going to have to let the market go for 2 consecutive bearish waves. Okay, so 2 consecutive moments in which the H1 time frame will have to see the context falling below a flat or bearish moving average. Okay, if the moving average is rising, it doesn't work out. Okay, so we want to see this context falling below a flat or falling moving average, and we'll be having the first bearish flow. Let this flow build a third range boundary, and then once the third range boundary is broken, you want to see the kind of price falling again back below the moving average, and your virtue for the second one, which means the second corrective flow will be done. Let the first bullish one build again, wait for retracement, and buy the second one. Okay, so that's what we have next in terms of sequence for the S&P 500. And in the meantime, well, you can just trade the volatility. Remember, 2.5 standard deviation, wait for the Bollinger Bands to open up and then close, and then you can trade the boundaries multiple times afterwards. All right, it's pretty damn straightforward. So that's the way to go. Okay, for cryptocurrencies, remember we have the same thing but on a different time frame. In here, we clearly have reached out a monthly bottom, both in Ethereum and Bitcoins. We knew therefore that the structure for flows will be in the 4-hour chart. Let me have a look at it on the high time frame so we see the whole sequence. Let me just actually pull out the trend channel so you'll see it all. Okay, so this is what we have. Okay, so the first flow has happened in here. Basically, that's when the moving average has been crossing below the rising context. Okay, so shown in here by the trend channel. We had that weird moment back then when we pulled back to this rising moving average, kind of leading me to believe that this was a quick first flow followed by a second one. Well, out of this duration for the big range that followed, we clearly have assessed that it wasn't right now, and clearly was a whole long first flow with its third range boundary there. And then in here we had a Bollinger Band contact. Okay, if you want to have a look at it in the reference time frame, that was basically this. Okay, so first big flow, give it a second to plot. All right, moving average standing out of the context, waiting for the third range boundary. There what was double top type 1. The market retraces right back down, and god damn it, why don't I have my Bollinger Bands? Visibility. Oh yeah, why isn't this guy in? Okay, so as you can see, Bollinger Bands was touched in here, so that's really the way to go. After the third range boundary, you could have bought in here at the rising moving average, and or in here, third and flow triggered here and confirmed by breaking the previous high point. That's just exactly what is described in the sequence. So your flow sequence is now in a second flow, waiting for a third range boundary. In order to get it, Bitcoin needs to retrace currently below 40K. That means going back there, building a third range boundary afterwards, and that's going to sign the end of this thing. We're going to have to wait for the Bollinger Band, which we've mentioned in the yearly briefing is not going to happen until somewhat like April or May, or let's say bare minimum March. It's of course depending on the volatility. Remember, there's no way for you to forecast volatility ahead of time. It's just going to have to react. Okay? So guesstimate not until March, April, late March, April, bare minimum, to eventually get a follow through in this second flow sequence. Okay? Meaning if we terminate it, the third flow won't be able to start until late March, April. Okay? And of course, the second flow, so long as it goes, can go on for longer than you think. So until you get the third range boundary, please don't play God. Don't try to get out of here like, oh, it's going to collapse. That's just another bubble or whatever. Okay, just try to be smarter than that. You have a set of rules. Don't ever listen to external noise. But that's really have been, frankly, to my humble opinion, the number one lesson for 2024. Truth is, I even decided to apply it myself. I genuinely didn't really enjoy my time on the social medias, but the thing is that, well, I still had somewhat the necessity to kind of communicate on those networks still. So that's the reason why I was still in Twitter, despite the fact that I really hated that thing. Well, truth is now, 2024, I decided to just follow my goddamn guidelines. That means Twitter is just noise. It's just stupid people saying most of the time stupid thing. There are clearly some quality stuff out there, but it's really diluted in the overall shitstorm. So that's really the way to go. I think Twitter isn't going to help you in trading either, and I decided to apply it myself, just to say, well, information in this market is certainly not going to be profitable for you when it comes out of Twitter. The type of information you can profit from is eventually doing your own research or the stuff you do. But looking at what everyone else can see is clearly not ever going to be to your advantage. It's just either going to manipulate your emotions or just blindly going to fool you into going for your trading biases, aka fall for uncertainty or stuff like that. Most of the time, the noise in Twitter will be doing exactly the opposite of what you should do, meaning they're going to be bearish when you need to buy at the Bollinger Band or at the bottom of the range or whatever, and they're going to be bullish at the top. So just don't ever listen to these guys. I think, well, deleting social media is the best thing you could do in 2024 if you intend to be a trader. Again, remember, just you can be in Twitter, but just don't look at traders. It's just like you can pick up whatever information you want out of Twitter, but don't ever consider trading information out of this. It's just absolute garbage. Okay. So that's it for this time around, okay? So for Bitcoin, we've done it. Ethereum, kind of the same. 4-hour reference time frame. And you can, of course, add your Bollinger Band 2.5 standard deviation and do the same old stuff over and over again. Okay? But what I wanted to add up this time around for 2024 as well is looking at the feedback that I had from users, mostly in French, there's been a lot of confusion between the two type scenario we can exploit. Remember, there are these flow sequence and their derived volatility on 2.5 standard deviations. But on the other hand, they were like, yeah, though there's this flow thing that you've told us, Phil, but what do we do with the shorter time frame range? Because actually this seems to be kind of two of the same things. And truth is, it's exactly the case. So this has led many, many people to confusion, saying, well, you tell us one thing in the pre-Z, which is basically, well, you told us into a range. Okay, oh, sorry, that's the French pre-Z. Okay, never mind. I'm just going to translate it. But that basically it just says you need to reject the context and you don't want to have a range on the higher time frame unless you got a range 2 time frames above. That's the rule that we've introduced back then to give you the ability to trade on shorter time frames, okay? And well, therefore, you have two conflicting kind of elements. You've got the flow sequence that allows you to derive from the low risk strategy into some more volatility driven trades on shorter time frames. Okay, and you're going to go 3 time frames below. If it's weekly, you're going to go H1, monthly H4, and so on. And that gives you trading opportunity derived from generally higher time frame, lower strategies. Okay. But on the other hand, we also have the opportunity to say, well, so long as you have a range in these time frames, you can just trade it. Okay, so the number one rule in here is that these two types of strategy are definitely able to work conjointly, but just don't work them in the same time frames. That means pick one of these. Whichever it is that you favor the most is the one you should use. And the thing is that you need to understand that these things we do here is not like just targeted advisory content to just you as a person. I am spreading this educational content for whoever is looking at it. And some people will prefer trading ranges using the context and the like. Some other people will like to use volatility-driven type strategies. And somewhat I wanted to give it some both. Give it to both. So that's really the way to go. I'm going to, for now on and for 2024, show you and prove you, just like we have proven by an entire year of track record following the US S&P 500 flow sequence over the year. I'm going to show you this year around that trading either with the range strategy, meaning third range boundary and dumb trading, is just as profitable than it would be using the flow sequence. It's just you can use either of those two. Just try not to use both of them in the same time on the same time frames, okay? What matters to me is that I don't want you to be buying the flow sequence and buying the bottom of a range at the same time, because that equals basically to doing the same converging trade 2 times, which means you just basically double your risk, which is something I don't really want you to do. Okay, remember that's a 2% maximum risk per time frame. Okay, very, very important to understand that. So don't ever mix up those two strategies just to try figuring out a trade. and to trade more, okay? If you have 2 trades on the same time frames or 2 consecutive time frames, trade one of these, okay? If you have a trade in 15 minutes and a trade in 4 hours, that's good, okay, that works. But try to avoid 15 minutes plus H1 plus H4. That's just too much overlap, okay? And then, well, you can use whichever strategy suits you the most, okay? And I'll prove it to you by just doing it right in front of you, okay? So how to do it with the S&P 500. If you want to do it with the range strategy. Okay, the best way to go is to use the dashboard in here that I built for you out of Pro Alerts. Okay, so for those who don't know anything about it, that's how it goes. You just add up to your indicator tab in here. You'll go to environment script where you will figure out normally alerts, framework, and momentum. You're going to open up Pro Alerts. Okay, and basically what's going to come out of this is that it's going to show you this. This is the multiple alert time frame stuff, which is, well, if you really want to know when something very particular is going to happen, you have a trigger logic, which is, yeah, you can get the whole set of 4 conditions to be combined to trigger the alert, or you can get a combination of alternate 2 joint stuff, like 1 and 2, or 2 and 4, or 3 and 4. You can get so many other alternate options like sequential elements, like then. That means I want the 1 to trigger, and then 2, and then 3, and then 4. You're going to have a sequence of events. So this is really absolute masterpiece. If you really want to know what you want to see in the market, this can be a game changer to you. So of course, by doing this, once you have triggered your stuff, okay, once you have selected your alerts, you will have to set an alert for this, okay? But otherwise, well, what we are mentioning here is the dashboard, okay? So that means you're going to select the time frames you want to scroll over. Just don't try to go into many lower time frame stuff, okay? And you click apply, okay? So remember, for the alerts, then this is how it goes next. You're going to go into the alert tab and you're going to select Pro Alerts, and that's basically your custom alert, okay? And you're going to set the conditions for this, the name, and whatever, okay? But for the dashboard, it's going to look like that, okay? And basically, the dashboard is this. You've got a series of time frames, okay? In here, the ones you've selected, and the time frames can either color blue, remain gray, or turn out red. Basically, that's simple as it is, okay? So there are 2 columns with coloring stuff. This column is just for trend. That's basically a simple condition, yes or no condition. It turns blue whenever the moving average is below the rising context. This is the way to go, okay? So that means the context is above the moving average. Turns red on the opposite correction. That means here, for example, that will be a red, okay? And anything else is gray. So by definition, you know that a range is when the moving average is inside the context. So if you want to trade ranges, yeah, congratulations, folks. You immediately know where to go. That means in the H1 time frame currently on the S&P 500, you can trade. You can go there. You know the moving average is inside the context. The second row, or the second column in here, is just basically telling you where the prices are related to the context. Okay? When it's blue, that means you are in the resistant context. The buyers are controlling prices, okay? Though we are under control of the bulls. The bulls are pushing prices into resistant context, okay? And that's really the way to go. That doesn't mean blue is buy, okay? It's quite actually the opposite. Remember, in a resistant context, you're generally selling, okay? So that means in the H1 time frame, and we're going to go just right here, okay, prices are under the control of the bulls, though the blue means prices are in the resistant context. So what you see here is just a bullish asset. I mean, the bulls are controlling both the price and the trends, but you still have a neutrality point in the H1 time frame. And remember what we stated it with the range, with the flow sequence, you have the H1 time frame third range boundary. So congratulations, folks. Here's something you can trade. It's just blatantly a third range boundary. Remember, rising moving average, first range boundary, we reverse the context, we've neutralized the moving average. This is a third range boundary, goddammit. Just trade it. So just look at the way it is. You have a range target, you have absolutely no signals, you don't even have sine wave. So we tend to say, out of this is really high risk at the moment to trade it, but that's a third range boundary. If you want to go for it, go for it. That's really the way to go, okay? That's one way to clearly use that thing. And you can derive that anywhere you want. Like just for example, now let's do the same exercise for Ethereum. Okay, and you take whichever time frames you want on. It doesn't really matter. The dashboard is going to compute this stuff for you on all the other time frames. So right now, as you can see, overall blue, that means the bulls are controlling this thing. And you have a very wide set of ranges. As you can see, you're trending here, you're trending there. And remember the rules you have in your Parisi manual. If you want to open up third range boundary or dumb trade, there's two things you need to do first. You need to make sure the contexts are rejected, okay? That we're going from the resistant context to the support context of some sort, and you need to have no range on the high time frame unless you have it as well 2 time frames above. So following this simple set of rules, what the hell can you do on these assets? Just focusing your attention here first. Where can I trade with a range strategy there? There's one thing I know is that if there is no range on the higher time frame, I can trade if I have a range. So H1 time frame can definitely be traded. It's neutral and there is no range on the high time frame. And I know that because the dashboard tells it to me. Okay, so H1 time frame, I can definitely trade a range on Ethereum. Otherwise, well, daily, can I do it? Well, seems like a yes, because I have a range in weekly, which normally should prevent me from doing anything, but I also have a range in monthly, so daily is okay. Monthly probably is as well, so long as there is a trend on the higher time frame. But that's really the way to go, okay? So, frankly, here I can trade daily and I can trade H1, and I'm just going to prove it very quickly to you. If I apply the goddamn strategy in Ethereum, it would probably work just efficiently, okay? So let me just clean up the Bollinger Band because we don't need them. Okay, so we're going to remain focused, and that's basically going to be the way to go. Whereas the last time we had a trend on this thing before we entered this range, that was out there. Okay, so that's our top, that's first boundary basically. Then second, we clearly reverse the context, moving averages is entering into the context, and that's basically the way to go. We have a nice third range boundary in here. Okay, it was inside the context, so this one you knew would probably break out the previous low points and had to be traded as a bearish third range boundary. Okay, you got all the signals needed back then to do so. So the trigger for entry point would have been this as a taking profit. Yeah, so not perfect for a neutral or bearish third range boundary. This one was perfect. This one has bearish trending signal detected by the algorithm. So this one was very perfect to trade as a bearish one. Got validated here and confirmed here as you joined the previous low point, which ended up being broken. Remember, you take your profits below the falling context, below the context on a bearish third range boundary. So target has been reached out perfectly for this one. But on the other hand, remember when you have full range boundary and plus, that means 1, 2, 3, so long as you get to the fourth one. So out of this moment precisely, you could use the DOM strategy. Okay, you take out the lowest low, even though this one was a weak. Out of this, you can take this one. Okay, but that's really the way to go. Back then, at that moment, this is where your fibs are. Okay, remember, below the context, below the fibs, what do? Well, there's a boundary trade. There's a DOM trade in here. You've got the context, you've got the sine wave, you've got everything, you got the signals, you had a target of breakout. If you don't buy in here, I don't understand. Frankly, let me just put you back into context of what you would see back in those in that particular moment. Right exactly there. Okay, you've got a context detection. Give it a second to plot the signals. So you're waiting for some signals there. You still don't have. Okay, here we go. I mean, if you don't buy that, I don't understand. I mean, the algorithms are plotting it all perfectly. You got the signals, you got everything you need. This is a 2% trade immediately for me. Okay, of course, that's a dumb trade. So you're targeting somewhat like the 50% retracement, the median price, and normally the moving average. This should all converge to the same area. So this is where you profit take your trade, okay? That's really the way to go. It's not overcomplicated. Are you going to be reached out to your target for this? Okay, give it a second. It's just absolutely buggy. Okay, boom, immediate profit taking. As you can see, there's no reason to be overly complicated with this. You probably would have been able to trade, remember the volatility on the H4 time frame, 2.5 standard deviation. It would probably have led you to similar trades. Really, it would have. Okay, so remember that if you're trading on the H4 time frame and you have H1 time frame boundary trades, probably they will be the same trades. So take one of these. Just don't double up the risk by taking 2 times the same converging trade. But as you can see, and we're going to take the entire year to forecast this week after week to just show you that both of these strategies have somewhat similar end results. They're no one better than the other. There are two ways to reach out the same goals. Just either you pick the ones you favor the most or not. It's really the way to go. If you're not really familiar with volatility, you don't want to add up this to the strategy, stick to the range strategy. And what we do here, as you see, is just as profitable as the other way around. Okay? It's really just not that simple. Just not that complicated. Though now let's give it a go, figuring that one out of Ethereum. So you've got your dump trades, you've made new lows in here. So what you're going to be doing is, well, you now entered the low, the dump area, which you know means if I have the context not so far away, and if we're pulling back into the gray area, I'm going to buy. Okay, so you already know what your next move is. Okay, give it a go. So in terms of new lows, that's kind of, yeah, not really that much. Gonna be enough. Give it a second. Needs to. Okay, as you can see, yeah, closing below the gray area, yeah, kind of. So if you're really buying the pullback in here, really need to have nice signals. Okay, give it a second. As you can see, not that easy to navigate. You got the signals, you're pulling out, you're in the context. I would tend to say, frankly, for me, that's still a go. The signals are there. I would be buying this. So that's really like buying this, and then you target the other boundary this time around. Remember, the dumb pullback means you go for the opposite boundary, and of course, you risk manage in the middle, but I would still give it a go. Okay, then, oh, look at that. If you don't trade that, I mean, that's just confirming the assumption. Everybody would probably be bearish. You know that the range is going to settle. Just buy that fucking thing. Now, opposite boundary to sell. Okay, you've had your risk limitation triggered, your stop should have been lowered, you're still in the trade, waiting for this area. Okay, whoa, 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 what the heck's going on? Sorry. Okay, here we go. Opposite boundary, taking profits, and of course, dumb trade. Get to sell that thing. Okay, that's really the way to go. Taking profits, same story, 50%, moving average. Median price, you know you're headed for that area to take your profits. And well, if I can show it, probably going to be touched. Okay, touched. So very, very simple, in my humble opinion. Okay, you take your dumb trades the easiest possible way. Okay, and out of this, well, same story. Wait for the next boundary or do nothing. But that's just the way. Oh, sorry, yet another boundary. Going below the context into the gray area, signal detection, go ahead, okay? So in here, it's not a perfect one. As you can see, sine wave wasn't really triggering, so goddamn it, go very easy on that one. But still, quickly taking profits. That's really the way to go. Out of this, the context is higher, so go easy. It's not the time to be absolutely outrageous, bearish. Wait to, making new highs, okay? Go easy on that one. No signals on momentum. Get patient. Let it build its market top. If it reverses, oh, sorry. If it reverses, you can go, but yeah. Absolutely nothing, okay? So in here, very dangerous area to sell, but all you know is that you need to readjust your Bollinger Bands, your Fibonacci's, and that's pretty much it. You've gone out, handled, just like before, very few candle closes in this area. If you sold out there, you're really still naked out of very few signals. You still have that, which frankly, I would tend to say is a good confidence signal to say, well, there are very limited chances that we're going to break out of this from this area. So if you shorted in here, well, kind of naked, 0.5% risk, certainly not anything more than that. But you would be able to do it, and yeah, you're profit taking as well. So that's a tiny risk trade, but still a trade. Reaching out to the moving average, and same kind of convergence area was 2300, and that's pretty much it. Okay, out of this, as you can see, we are in the down zone. So if it goes right back there, though the context is still there. So if the context reverses, give it a second. Yeah, it does. Is it going to pull back? Yep. Okay, you can go again. Now, that's really the way to go. It isn't goddamn complicated. You've got your context in here. Okay, you're back into the down zone. You're back into the boundary trade. You've got your detection. So there as well is an area to try a boundary trade. That means you sell, you target the opposite boundary. Once again, in here, everybody will be freakingly bullish on Twitter and so on. So just don't listen to it. Okay. Risk manage. You've got your triangle trade, you have a boundary, you've got a divergence pattern and overload momentum. Go ahead. You're next to the context and you have done your pattern. Go there and that's it. Okay, just once again, no magic. Boom. Okay, it's really the way to go. It's just, I'm sorry, I don't like magic, I just like rules. And the thing is that, well, now what do you have in here? You're far below the context. You've got into the gray area. What do you do here? God damn it, you buy again. You have no signals, so you're really going naked there. But I would tend to say, yeah, want to try it? Try it as well. At least don't be a bear there. And once again, boom, you go there, and you would see there's a problem here. Clearly, you can see the median price is now very low. Because this shadow clearly shouldn't have been detected. I mean, in here, I don't really understand how the indicator caught this one. But anyway, that's the way to go. It retraces to the median price again, the moving average, and so on, and the 50% retracement. You're profit taking once again, and that's pretty much it. Okay? So now, do you really want to widen your range to account for this thing? I would then say, yeah, maybe not in my hand. Okay? So now let's go back to real time, because we're kind of closer to it now. And that's really the way to go, okay? Boom, what you had in here, yeah, another boundary. What you have there or there, yeah, you have another boundary. Everyone's bullish now, you've got a target, you've got a taking profit. Frankly speaking, I would be selling in this area. And in here, either you're gonna take the stop loss, that's just gonna take you out of this range. Remember, this range is goddamnly mature now. So it's really going to be broken at some point. It's really that simple. Okay, do you really want to account for this low? Then say, I don't know, this is really a low shadow candle. If you do it, well, anyway, you're still in an area to sell. That means here you have very limited but still some signals you can sell. You have the taking profit in here. You have the breakout pattern for this, so that's really the way to go. This time around, if you sell this one, it's either yet another boundary, it's going to retrace back out to the median price again, or this one's going to broken out. Okay, clearly remember, at some point, range is going to be broken out. It's really the way to go. You're inevitably going to take a stop loss at some point trading in a range. All right, but as you can see, it wasn't that complicated. We could clearly trade on the H1 time frame, and now, as you can see, the daily can do it as well. Remember, daily is a range, okay? So daily is the way for us to go. Though remember, previous trend that we had on this asset was bullish, okay, daily chart. So clearly, you're going to take the high points, and you're going to figure out, the third range boundary. And as you can see, we have done context reversal. The third range boundary wasn't there, so this is kind of weird. In here, like I said, I think Ethereum could have done a bit better there. That means, well, first, second range boundary, and third, and the like. Okay, so in here, anyway, remember, so long as you see these volatility alerts, that means the range is mature. It's written down in the pre-Z. That's one kind of rule that most people don't really pay too much attention to. But remember, when you are squeezed out, you really don't want to trade anything but a mature range. So put your fibs, and you got it all for Ethereum. Okay, top, bottom of the range, clearly, and that's the way to go. Where are we? We've clearly made candle closes below the lows. We're here, so if Ethereum dares going 1800, I'm buying eyes closed. So we're not yet there. I wanted to enter the down zone, and if it ever pulls back down to 1800, that's a clear need buy for me to then target 4000. That's the way to go. Pure and simple. You want to do it? Do it. H1 daily time frame is okay. Remember, it's ranging in the weekly, but also in the monthly, so go ahead. That's really the way to go. That's really the way to go. Okay, that also means you can still apply the goddamn rule in monthly as well. Okay, monthly is a range, that's the larger range, so same story. This range, as you can see, is kind of more bullish than bearish, so third range boundary in here. We're going to get there. I know you don't think so, but we're going to get there whether you like it or not. So that's the way to go for me. All right, it's not complicated, and you can apply that in any asset you want. Okay, like for example, you want to do it in Hang Seng. Well, just look at the dashboard. You know, anytime there is a trend, you can trade anything else. Okay, so you can trade daily, you can trade H1, definitely going to work out, and probably the monthly as well. All time frames you can play ranges on. Let's give it a go. Let's go Hang Seng for 1 hour and see what we can do out of this. Okay, so give it a second to plot. Okay, here's our range, here's the bottom, preceded by a bearish trend. So that's clearly not that complicated for us to navigate. Let's just figure out the majority of that range. So that's first, second range boundary, third range boundary there, fourth. So here is a nice third range boundary. You could have traded it or not, depends on what you want. Types of signals were very, very narrow, absolutely nothing for you to trade it. Though you're 4 boundaries and more, which means same story, take your fibs and start to play dumb, okay? So back in the days, you only had that, which means here is a nice one for you to trade. Boom, signals, breakouts, attempt to range breakouts, clear net sell signal in here. Sell the fucking boundary here, adjust your fibs, and that's really the way to go, okay? You've traded above, so you knew that if you were going for these prices in here, you would have sold again, targeting this. We didn't really go there, but that's really the way to go. So you have your nice boundary trade, profit taking quickly there, and that's where the way to go. You're waiting for, boom, the opposite boundary. You want to trade there, you don't have signals, wait for here. Okay, here, you got everything you need. Exit patterns, everything needed, breakout target to limit the risk. God damn it, buy that thing, it's going there. That's really the way to go. You dumb fucking trade, okay? There's a mandatory profit taking here. If you really want to go all the way up to the opposite boundary, you can. But whenever you get there, sell trade again. Remember, right now you know that you have a neat sell trade at 17,000. Basically, in here, you're above the context, in the area to sell. You can leave some trades there. That's the way I personally do things. I have selling trades right up there. That means I'm taking the trade no matter what, somewhat like 0.5 or 1% capital, and then I adjust according to the signals that I'll get there, which means I take the trade first, and then looking at the risk limitations I have, either I cut the trades or I increase the position sizing, and that's it. I'll collect the information in the area to risk manage my trade, but most of the time I know exactly where I'll trade, which means I already have trades ready for this. That's really the way to go, okay? So I hope you guys are going to learn from this. This is going to be a long first video for this year. Don't worry, we're not going to make 45 minutes long all week, all Wednesdays. But that's how I want to clarify all these things. These two strategies, volatility-driven or purely assessing range out of dashboard time frame referencing, are two very compatible strategies. Most of the time, they will lead you to the same conclusions. The difference is, I'd rather like you to follow one or the other. Pick the one that suits you the most. Forget about the other, okay? The number one mistake not to make is to jiggle around the two and to say, well, this time around I feel like I like volatility because it seemed to have worked better. And then later on, when it starts to work slightly less better, you're going to go for the range boundaries. Though, okay, one thing is for sure, and I'm going to prove it to you over the long reference of another year, and that's going to be my end game for 2024. Prove you, statistically speaking, that using one or the other is probably just as much profitable. Okay? The truth is, you're going to just confuse yourself if you try to play around the two of them and switch between one and the other, one and again. Just don't do it, okay? Pick one and stick to it. I'll prove you by using both that they definitely work as much as the other. All right? So to avoid that confusion over again, I've wanted to clarify these things, and I'm going to put it into motion over 2024 to actually prove it with statistics. All right? So that's going to be more than enough for this time around. I wish you all a nice year 2024 ahead. And by that being said, I see you guys later. Bye-bye.